All right, dear investors, welcome to my first lecture. I will show you how you can find amazing shares. When I say amazing, I mean shares that look better than its closest peers from the fundamental standpoint. And for this, we'll go to the stockstobuy.net website. And once you're on this website, click the top bar button, Stock Screener and Portfolio. And it will bring you to this amazing, simple yet amazing screener. Well, most of the screeners, they have different complicated financial ratios, and for beginner traders and investors it can be overwhelming. It's difficult to understand what filters should you use to find stocks that are tailored to your risk profile. And here I think risk is very important. It's one of the vital things that you should pay attention to. That's why I rely heavily on filtering stocks that are based on the risk. Number one thing is the risk. And in this filter, we have a low risk profile and a risk-seeking investor. So since I'm a risk-averse investor, I'm choosing the low risk appetite. Then you have a desired return. You can change your desired return to whatever you want. Let's say I want 45% yearly return. And then you can choose an exchange. I'm leaving this field blank. And you can choose the country if you want. If you leave this field blank, it will find you stocks from different countries. I mean the emitter company, the company that is issuing share. As you can see here, there are different countries, like for example Japanese company, but the stocks will be listed on the US exchange. I usually put the US filter, US country, because these are more stable stocks. They don't have this currency risk, geopolitical tensions, geopolitical risk. That's why I'm choosing these US companies. When you choose a company that is based on another country, you have additional risks, maybe some tariffs, maybe some currency devaluations or something like that. That's why I am choosing the US here. But of course you can leave this field blank, and as I have said, you will see stocks from those countries as well. And then I choose the screen stocks. I'm hitting the screen stocks button, and now I see a lot of companies, US companies. US is the emitter, the United States. You can see the exchange, the trading volume. This is very important. The higher the volume, the more stable the company, because high trading volume companies usually less volatile. When you have a low trading company, it can be very volatile because larger volume can affect the stock price heavily. Then the market cap, as you can see, these are companies with huge market caps. And the beta is the risk of your chosen stock in comparison to the market. When I say market, I mean S&P 500 index. So it compares the stock volatility. For example, if you see the beta of 2, it means that your chosen stock is 2 times more volatile than the S&P 500 index. So since we are risk-averse investors, I'm choosing companies with low beta that are less volatile than the S&P, than the market in general. When analysts say market, they mean S&P 500 index as a benchmark. So, and from this list of companies, you can choose different companies. These are stocks tailored to your risk appetite. For example, you want to buy Walmart share from this list. These are all, as I have said, these are all stocks that are tailored to your risk. And you can choose the Walmart share, for example, but the problem is that the stock price is $115, and you don't know whether this is expensive or no at the time of purchase. You cannot just say based on the price, because companies do have different businesses, have different financials, and we should examine companies' financials to tell whether the company is efficient, whether the company is better than its closest peers. Now, before choosing the stock, we already have the list of stocks. Now we have to choose the best stock from this list. These are stocks tailored to your risk appetite, and now we need to choose the stocks that are stronger than its closest peers fundamentally from the fundamental standpoint. For that, you can hit on the ticker. For example, I'm choosing the Walmart share. I want to buy it, but I don't know if it's strong fundamentally yet. I can click here, and the app is searching, extracting the information. Or another way is you can open the separate tab here by clicking on fundamentals over here. And once you click on stock fundamentals on separate tab, a new window opens where you can see companies fundamentals. And now you type the stock ticker here, which is WMT for the Walmart share, and hit the analyze button. Now the app is extracting the data, and you see the company name, current stock price, market capitalization, which is the number of shares multiplied by the price. And you can see the industry, price to earnings ratio. Skip this earnings part. We will get back to this part in the next section of the course. Now, what information you see here? You see the most important fundamental information of the company. Well, I worked with stocks on a trading desk where I was working with equities, fixed income, FX, with different financial instruments. Since 2007, I was working in a treasury. I was part of the treasury team in the banks, and part of my job was trading shares. And I spent many hours analyzing companies, and I know what are the most important financial ratios, what are the most important things to pay attention to when analyzing the stock. And in this dashboard, I collected the most important things that you need when analyzing share and deciding on which stock to buy and finding the best stock among closest peers. So you don't have to spend time searching through different websites, analyzing, reading analyst reports. You can just use this dashboard that shows everything you need to find amazing stocks. For example, with the Walmart, which is what you see. Just ignore this step. We'll get back to it as I have said. First, you see analyst targets. So the stock target price is the forecasted price of the share, the price that the stock can reach in the future if those analyst forecasts will come true. There are different equity valuation models. Equity valuation is the model that calculates the stock fair value or the stock target price. There is a discounted cash flow model, dividend discount model, or multiples model. And analysts use different models to assign the stock target price and growth potential. And as you can see, there is analyst targets. So these are target prices calculated by different investment analysts from larger, well-known world investment banks. We will get back to this thing and you will see how this thing is calculated in more detail. For now, I'll just go through real quick. Well, analyst price target in this dashboard, you see the minimum price calculated by some analysts. So one analyst believed that the stock target price for Walmart can be $28 per share. The maximum price is $210. Someone believes this as realistic price. And the average price is $129.96. As you can see, there are 176 analysts who were calculating the stock price for Walmart. Now, what you can do by looking at this heat map, so to say, first you look at the spread. The higher the difference between the minimum and the maximum number, the more aggressive the stock movement can be in the future. So if you see huge dispersion, huge difference between the minimum and maximum price, it means that the analysts are applying huge price movement upside or downside of the stock in the future. It can be very volatile. We'll compare it to the closest peers and you're gonna see it. So the average price is 129 and the current price is 115. It means that the stock is undervalued a little bit, still has some growth potential. It can reach 129, but still it's not that great as of some peers, because some companies can have 20%, 30%, 50% growth potential. It is moderate growth potential for the Walmart share. As I can see, an analyst can use different valuation models to come up with the stock target price. They're not sharing those models, I mean the calculations that they are doing, but they can use DCF, DDM, or multiples model when assigning the stock target price. Now also you have the insider trading stats. As you can see, this is the total shares that are bought or sold by insiders. These are legal insiders, meaning that these are traders of the company, someone who's working in the company. So these are company workers who are selling the shares, maybe some executive, maybe a CEO, maybe CFO, someone who is managing the company, very important people, middle management or upper management, who is selling or buying shares. So with Walmart, you see that almost 5 billion shares were sold in the fourth quarter of 2024. It is a huge number. And if you see a lot of sales, that's a bad indication for the Walmart share. But we see here one-time sale. Of course, you can go to the company website and see analyst reports. Maybe you can spot what was the reason for this sale. You can investigate this further. But as I have said, this was only one-time sale. But if you see a lot of sales quarter through quarter, this can indicate bad things, and you need to investigate this further. Now you can see evaluation based on the price to earnings. This is a price per share divided by earnings per share versus sector. As you can see, the company has a 40.3 price to earnings ratio. This is TTM, meaning it's a trailing 12 months. It is calculated for the 12 months. It means it is 40.3, and the sector average is 38.8. It means that the stock is fairly valued, almost fairly valued, based on this multiple. The console provides a conclusion. It says above average. It means that the premium valuation. But in reality, it's not that premium. It means overvalued, but in reality, it's almost fairly valued because the company price to earnings is close to sector average price to earnings. For example, if you see larger difference, for example, company price to earnings is 20 and the sector average is 40, it means that the company is undervalued 2 times, so the stock is trading 2 times cheaper based on the sector average, again based on this price to earnings ratio. But still, you don't have to make your conclusions whether the stock is overvalued or undervalued solely on one multiple. You should go through different multiples, and in this video we will do that. But based on this multiple, the stock is almost fairly valued. Based on the average price target, the stock is very close to be fairly valued, but still has some small growth potential. We can find stocks with higher growth potential among closest peers, of course. Now let's go to very important part. These are key metrics. These are different metrics and ratios of the company. These are the most important ratios in the financial statement. And now let me explain you what those ratios mean. For example, with the return on assets, it is 7.9. Return on assets is calculated as company's net income divided by average total assets. So we take the yearly average total assets, and you should compare it to the closest peers. The higher this ratio, the better it is. It means that it shows how company is generating its profit with the existing assets. For example, if you see the company with the ratio, with the metric of 20, for example, and our analyzed company has 10, let's say, it means that another company is 2 times better, 2 times more efficient in utilizing its assets. Another ratio is return on equity. We will be comparing this to the closest peers, don't worry. So you'll see how we do that in a real example. Now you see the return on equity, which is 25.4. It is calculated as, again, net income divided by average shareholders' equity. Well, the same rule applies here. The higher, the better. We see 25.4. You should remember those numbers when comparing to the closest peers. If you see very high ratio, maybe like 50, 60, 80 or 90, 100, more than 100, it is considered extremely high. It may be caused by share buybacks. Buybacks are usually good because they support the shareholder. The company is buying back its shares. Or maybe it can be caused by low or negative equity. So just remember those numbers. I am explaining what those numbers mean, and then a little bit later we will be comparing it to the closest peers later in this video. Now ROIC, this is very important, return on invested capital. ROIC is a NOPAT, or net operating profit after tax. You take the profit after tax and divide it by invested capital. The good number, like the average good number, is 20/25%. Is extremely excellent, I should say. But Walmart still need to work over and to improve this ratio. Now free cash flow yield also with ROIC also it was mentioning that the higher the ratio, the better it is. Same rule applies to free cash flow yield. Free cash flow is calculated as the company's cash flow. Cash flow is the key because free cash flow is used to buy back shares. For example, free cash flow is the cash flow that is retained in the company after its inflows and outflows of the money. As you know, company has 3 main sources of inflow and outflows, sources of income, I should say: operating, financial, and investment. So there are 3 cash flows, and after deductions and additions, we have a free cash flow. So this is something that is left at the end of the quarter or at the end of the year that company can use. Actually, it's a free cash flow that the company can use to reward its shareholders, to pay dividends, to buy back shares, and so forth. And the higher this number, the better it is. And free cash flow yield is calculated as the free cash flow divided by the market capitalization. Or sometimes you can divide the free cash flow by the enterprise value. Enterprise value is the company's value. Also, the higher the number, the better it is. It is telling about whether the company is using its cash flow efficiently or no. Another very important ratio is enterprise value divided by free cash flow. From the name, you see that it's enterprise value, the company value, divided by free cash flow. With this number, if previous numbers, the higher the better. With this number, the lower the number, the better it is. So enterprise value, you may think of it as the company value, as I have said, and the free cash flow. In simple words, it tells us in how many years this company's free cash flow can buy back its own company. For example, if enterprise value to free cash flow is 2, it means that the company has a lot of free cash flow that it can use for development, for investing, for buying new equipment, for paying workers, for buying back shares, for paying dividends. If this ratio is 2, it means that in 2 years the company can buy back its own company. So it is repaying its own operations, so to say. So in case of Walmart, the ratio is 29.95. And to tell if it's good or bad, we need to compare it to the closest peers. Maybe it is normal for this sector. Maybe it's normal for consumer defensive sector, and we'll see it when we'll be analyzing it further. Now let's go to financial ratios. We have a gross profit margin. Gross profit should be stable. That's a good indication. And it should be higher than peers. If it's higher, it means that the company is managing its cost in a good way. And the stability also tells that stability means higher predictability. Gross profit margin is calculated as revenue, the company's total sales, minus cost of goods sold, divided by the revenue. So you tell how many profits the company retains after deducting its direct costs or cost of goods sold. In case of Walmart, gross profit margin is 24. It means from every dollar of sales, the company retains 24 or almost 25 cents after deducting its cost of goods sold, or sometimes called direct expenses. As I have said, you should compare it to closest peers. Now we go to the PEG ratio. PEG ratio is very, very important. PEG ratio gives analyst vision on the company's future growth, so to say. PEG ratio is calculated as the price to earnings ratio divided by annual earnings per share. Generally, higher than 2 is considered expensive. The stock is very expensive, and lower than 1 is considered cheap. The stock is still attractive because analysts expect higher EPS, earnings per share growth in the future. So in case of Walmart, it's 5.33. It means that the company is very, very expensive, but it's a good company, more or less stable company. Walmart is paying good dividends, so they are rewarding their shareholders for holding shares. And larger companies like Walmart can have such a big ratios. Now you see revenue segmentation. You should pay attention to this graph too. The company should be diversified. Their business should be diversified. In case of a Walmart, its business comes from Walmart US, 68%. International, it comes like 18% comes international. Then Sam's Club, 13%. Also diversified, but not as diversified as of Apple, for example. Of course, it's not their closest peers, but we're gonna see their closest peers too and see how they distribute their portfolio through the revenue segmentation. Of course, in this dashboard, you also see very important company news. And then you see the financial statements growth. This thing is extremely important because you can see how things in the financial statements were growing or declining. These are very important things. For example, debt. The company was increasing debt or reducing debt by around 4%. It's not critical. Here was a 12% reduction. In 2022, it was 9% reduction in comparison to the previous year. This is a good sign. This means that they are getting rid of some of the burden. And also, but here you see the free cash flow decline. It means maybe they repaid some portion of debt and they have less free cash flow. Or maybe they have invested in something. When you invest your free cash flow, it takes years to repay back your investments before this plant or before this building starts bringing good profits. As you can see, in case of Walmart, it is in 2025, it was decline in free cash flow, which is a bad sign. It means that the analyst may consider reducing the stock price target when making their forecast. In 2024, we see great increase in the free cash flow. Maybe in this year, analysts raised the price targets. When you see, at least for 2 years, you see good cash flow increase, at least more than 10%, you may make a conclusion that analysts will raise the target price in the coming months or in the coming quarters. More than one analyst, maybe 2, maybe 10 analysts will start increasing their price targets because the free cash flow gains significantly. But in case of Walmart, we see decline. I would not say huge decline, but a large decline. And the revenue increased only 5%. Gross profit and operating income also increased, which is a good sign. And the net income increased 25%. It means that the company managed to improve their operations, reduce some costs, or maybe there was some adjustments. If you see a huge number, you can investigate, go to the income statement report and read analyst conclusions. And you can see in the past 2 years, Apple managed to improve their net income by more than 20%, 32% in 24, and 25% in this year, but this year still didn't end. We'll see the result, and you can see they pay good dividend, 9.4% per share, 9.6% over here. Maybe this reduction in free cash flow was caused by a good dividend payment. And then you see a DCF risk level. What mean this is a DCF model, the stock target price calculated based on the DCF model. It means that the stock is heavily overvalued. That means it's trading very expensive. As we saw, the stock price was 115, and DCF tells that the stock fair value based on the free cash flow estimate is only $26 per share. This aligns with some of the analysts. As you can see, one analyst put the minimum of 28, and our DCF model, this model is a discounted cash flow model, so you forecast the discounted cash flow. I will show you how this model operates, how this model functions, and you'll also get the access to this model. In my blog section, I have a premium content, and you have access to this premium content. You can download this model. I have Excel download and Google Sheets download, where you can download this model and see the components of this model. And this applies that the Walmart has a 77% decline potential because the share price is overvalued. Before I show you this DCF model in Google Sheets, we can jump to the Walmart's peer and compare some of the closest peers and see if they look better. But before I do so, this interesting graph, it's a current share price, and you see the risk level. This is a stop loss and take profit. So if you bought at the current 115, you should sell it with loss at 111, put the stop loss, and put the take profit at 118. The stop loss and take profit are based on the standard deviation. So this controller adds 3 standard deviation to the current price, and it shows you the take profit, and for the stop loss it adds 2 standard deviations from the current price, and it gets you the stop loss. Of course, if you don't know why you should set it, maybe you don't want to lose a lot, but still you want to hold share, and you set the stop profit to limit your losses in case the stock starts declining. But of course it may decline to some level, let's say till 114, and then start rising again, and you don't want to sell the share too early. That's why some analysts or traders, they put the stop loss. And for the take profit, if you are trading the share short term, you don't know when to sell it, you can add 3 standard deviation and sell at 118 if your trading horizon is within weeks, for example. So now let's go to this peer comparison table. This is very important table. You can use it to find the best peer among Walmart's competitors. To pick the best peer, we can pay attention to the market cap. As you can see, Costco is also a large company. Walmart has $970 billion market cap. And when choosing its closest peers, we can choose the Procter & Gamble company, we can choose the Coca-Cola company, or we can choose the Costco corporation. It is the closest peers based on the market cap. The Costco stock price is 194 and Walmart price is 115. But based on the price, you cannot say whether the stock is expensive or no, or cheap, because as I have said, different businesses, different scales, different business models, different financials, and to compare the stocks and tell which stock is closer and whether this Costco stock is cheap or no, we should analyze it fundamentally too. For that, just remember those numbers that we analyzed. For that, let's go to Costco. Just click here and let's see its key metrics. Our main goal is to pick the best share among closest peers. Again, we are ignoring this part for now. We will get back to it in the next section. And now you see insider trades, buys and sells are more balanced. So you see 65,000 shares were sold, were bought, 40,000 shares were sold. But based on this graph, you see that more insiders are buying the share, someone who is working inside the company, than selling the share. But overall, this graph looks even. So they are buying, they are selling. It's a good indication. You don't see such a huge jumps as with Walmart. Now you see the valuation based on the price to earnings, also almost fairly valued because these numbers align close to each other. Now let's see the return on assets. If you remember, Walmart had 7.9 return on assets, and Costco has 10, which is better. It is using its assets more efficiently. Return on equity, Walmart had 25, Costco has 30, better than Walmart, but still not 2 times, not 3 times. Return on invested capital, Costco 19, Walmart had 12. So Costco is a true leader here. And it also has, but it has lower free cash flow yield, because if I remember correctly, Walmart had 3.5 free cash flow yield and Costco has less. The Walmart is winning here. And enterprise value on free cash flow, Costco has higher because Walmart had 30 and Costco has 49, almost 50. Still, Walmart is a clean leader here. These things will show its beauty maybe later, maybe in 2, maybe in 3 years, maybe if the company, this is a case especially when the company is investing heavily into something, when the company is using its free cash flow for something. And then when this factory or plant or building will start bringing huge profits, you'll see these things are improving. But these things are more important, free cash flow yield and enterprise value to free cash flow, and the Walmart is a clear leader here. And the gross profit margin, it has 12, where Walmart had 24, almost 25, 2 times higher. So the Walmart is true leader here. It means that the management of Walmart is managing costs better. And the PEG ratio is 14, incredibly high. It means that the stock analysts expect EPS growth will be much 3 times slower than of Walmart. So Walmart is still winning here. Operating free cash flow to sales. Again, if you remember, Walmart had around 6. It had a 5.8 operating free cash flow to sales. Again, the higher the number, the better. And Costco has 4.8, lower than Walmart. Again, this is very important ratio. And Walmart is a clean leader here, but in case of a revenue segmentation, Costco is winning here because Costco has more diversified revenue, more protected business, so to say. Let's see the financial statement growth over here. In terms of financial statement growth, higher revenue growth, higher operating income growth than Walmart had only 8. Let's see the free cash flow. This is the most important. As you remember, Walmart had a 16% decline, where Costco has a rise in the free cash flow. It's better. It means that the analyst may revise their target prices upwards this year, and this may affect the current stock market price also positively. As you can see, but the dividend per share declined. Maybe they're collecting money for something. But in 2024, they had a great dividend per share rise. This is a good sign. Slight free cash flow decline. You can analyze yearly. I don't like here that they have huge volatility in the free cash flow, so 34% decline in 24, then 92% rise in 23, then 1 point decline in 24, and in 25, 18% rise. When you see this decline, it means that it's very difficult to forecast the share price, to calculate the stock target price, and the stock. This may result in higher volatility of the price in the future. As you can see, also high gap between the mean and maximum price, but the average price is 758, and the current price is 894. I'm so sorry. And the current market price is higher than the target price, consensus target price forecasted by more than 100 analysts. It means that the stock has a decline potential to this level, that the share price is overvalued. It means that the Costco is trading much expensive than the Walmart. And based on the DCF valuation, it shows 306 target price, which means that the share is 65% overvalued, which means it's trading expensive. So based on these two companies, I think although they are still overvalued based on DCF, but Walmart looks better based on financials and based on key metrics and financial ratios. Now we can go further and we can analyze smaller peers, but I would not recommend that. I recommend you analyzing companies of the same market cap to find better companies. But still, Walmart operates closer to the target, closer to Dollar Tree, to Dollar General, and we can analyze smaller companies. Let's say you want to buy smaller companies. Let's say you want to invest less than $100 on a stock per share, and you can analyze Target Corporation. Let's see how Target is doing. Still, it is much smaller than the Walmart, 41 billion market cap. As I have said, you should analyze companies those market cap is larger because Walmart has larger market cap. But for the exception, let's see the Target share price and whether it's trading high, whether it's expensive or no. And as you can see, based on the price to earnings, the stock is trading cheap, undervaluation, because the company has 11 and the sector average is almost 40, almost 4 times undervalued. Current market price is 92. The analyst average price is 181, which implies good growth potential, almost $90 gross potential per share. This is a good sign. You see 149 analysts were calculating this. Insider trading more balanced as with the previous company. Now let's see the key ratios and see which company is the true leader here. As you remember, Walmart had 7.9. Walmart is better. Return on equity almost equal to Walmart, almost 25. Return on invested capital close to Walmart. Walmart had 12. Free cash flow yield, amazing free cash flow yield. Walmart had 3.5 and this one has 7.2. Amazing free cash flow yield, 3 times better than the Walmart, 2 times better. Enterprise value to free cash flow, Walmart had 30. This one has 19. Amazing result. Financial ratio, gross margin is 26, higher, slightly higher than Walmart, but almost the same. PEG ratio is lower than the Walmart. Operating free cash flow to sales is 6.4. Remember, Walmart had around 6. It had 5.8, I think. And here we have a higher operating free cash flow to sales, and Target demonstrates a better performance here. You see great diversification of the business. This is amazing result. Now you can see the price target is 182 based on the DCF model, which implies 99% gross potential, almost 100% gross potential. Amazing result. You can see great free cash flow growth, slight debt increase, slight net income decline, but I'm more interested in free cash flow than in net income in this case. You can see great free cash flow increase in 2023. declined 129% in 22. Although huge volatility in the free cash flow, we still see a good increase in the free cash flow, but I don't like this volatility in this free cash flow. But still, Target is smaller than the Walmart, so smaller companies can afford this lower predictability in the free cash flow. Still great result. Target is my top pick among these companies. So if you're choosing among those three companies that we analyzed, Target is a true leader based on the ratios, based on the price target. Again, we'll return to this earnings thing a little bit later, based on the revenue segmentation, diversification, based on the DCF price target, and based on the financials growth. So if you're wondering which stock to choose among the consumer defensive, among the stocks we analyzed, I would recommend you analyzing Target. And by doing it the same way, we can analyze other companies as well. Now, let me show you this thing, how it's compounded. I have a separate Excel file. So once you change the ticker over here, you can see, let's see with Walmart WMT. And the model is calculating it. Again, you will have the access to the model. It is showing you the news URL. You can click on this URL and you can see this news, including the name of the analyst, investment bank who was calculating the price target for Walmart. As you can see, this is the adjusted price target for Walmart, calculated who was publishing it. This was the UBS analyst. UBS analyst calculated that the stock target price for Walmart should be 130. Someone calculated 115. Someone calculated 117. There are also low target prices in this table. We have different price targets calculated by different analysts. Let's see the target as an example, TJT. They use different valuation models as I have mentioned. Over here, you should pay attention to the most recent price changes, price targets, and the most recent price targets tell us that the adjusted price target is 99, almost fairly valued to the stock current price, not implying the growth potential. If you analyze not average, not the consensus price target, if you see the most recent price targets, you can see the RBC analyst calculated the price target of 99 for Walmart shares. And also this table gives very valuable comparison of ROIC. It's a return on invested capital. So it's a company's return on the invested capital, and the WACC, it's a weighted average cost of capital. So this is the cost that the company is bearing for its structured funds, including issue of the debt, including shares that the company is holding. It's a 7, and the return, ROIC, is the return on this invested capital, so it's 9. And this ROIC should be always higher than the WACC. If it's higher, the coefficient is 1.28. When we divide ROIC by WACC, it means that the company, the target, is using its capital efficiently. Let's look at the Walmart WMT. Walmart is also using it efficiently. It's actually using its capital better because return is 12 and cost of capital is 6.57. So Walmart is using its capital more efficiently. Now we go to DCF valuation. You will also have access to this model. It's in the blog section, premium content. You can see the DCF model over here. This is the same model that professional analysts use to calculate the price target. Again, you don't have to do it manually, just fill in this thing. You can fill it manually. Go to Yahoo Finance website, for example. Over here, input the stock ticker, then go to financials. When you go to Walmart, WMT, choose the stock. We are doing this to calculate the stock fair value, gross potential manually. Go to financials. But again, you don't have to do it manually because the stocks to buy controller over here already calculates it. Over here, we have a DCF model. This is for Target. Also, we have for Walmart. But if you want to calculate it manually, I'm showing you how to do it. And you have this financial statement. You have income statement, balance sheet, and cash flow statement. And you just have to fill in these things that are required over here. You can fill it by hand. And then you calculate the free cash flow from here. You can calculate it, or you can use analyst assumptions. For example, someone believes the free cash flow will be rising. Someone believes that maybe company management is saying the next year free cash flow will be this amount, will be rising 5%. Or you can use the this controller, and you see the free cash flow rise. You can take the average rise based on the 5 years and apply this rise to the next year, and this is how you can forecast the free cash flow. But as you can see in my model, I apply only 5% growth to the free cash flow, and then extrapolate this to different dates. For example, for 2027, I think that the free cash flow will be the previous year free cash flow multiplied by 5%, and this will be 17 billion for the next year. But you'll get access to this model. You just have to input the stock ticker. As you see, as I have already inputted the Walmart over here, and it is extracting me revenue, EBITDA, it's earnings before interest and tax, it's earnings before depreciation and amortization. You can see the beta over here, you can see the cost of debt, you can see the tax rate, you can see the weighted average cost of capital. You have everything needed to fill in this model, and once these numbers are filled, once you change this 5% to something that you want, the model will calculate the stock fair value. Well, the discount rate, it's a WACC. We already talked about weighted average cost of capital. Perpetual growth rate, since I'm forecasting for 5 years in advance, perpetual growth rate tells you what you think the free cash flow growth will be after 5 years. So I think the company will be growing free cash flow 5% every year, and after 5 years it will growing it by 1%. So I'm implying very conservative assumptions. Last year EBITDA is earnings before interest and tax. You can take it from financial statement. Put the transaction date, current share price. You can put the shares outstanding again from the balance sheet. Debt, you extract the total debt from the balance sheet, cash again from the balance sheet, and then the app calculates you the free cash flow, discounts it by the weighted average cost of capital. As you can see here, the cost of capital is 6.57, calculates the company's terminal value. It is using this formula. I also have all the formulas for calculating the terminal value. You can use this Excel spreadsheet to see how the terminal value is calculated. Then you discount free cash flow and terminal value by the discounted rate, and then you get this enterprise value. Enterprise value, it's a forecasted company value. Then you add company's cash to this enterprise value, subtract debt, and you get the total equity value. After that, you simply divide it by the number of shares over here, and you get the forecasted share price. And based on the DCF model, the Walmart has a 29.10 target price, which is heavily overvalued. Now we can do the same thing with Target, TGT, and see the stock growth potential and price target. As you can see, these numbers are extracted. It implies 100% growth potential with the price target is 184. So based on our research, based on our quick analysis, we see that the Target is a true leader among analyzed companies. And if you are deciding which stock to buy, Target is the true leader based on financials, based on growth potential, based on its stability, based on the business diversification. So I hope you liked this video, and by doing the same way you can analyze different companies and construct your efficient portfolio of stocks. But don't build your portfolio for now, because you still need to watch my video on building the portfolio, but we'll be there very, very soon. Thank you very much for watching my first lecture. See you on the next lecture.